students, welcome back to Accounting 1304, Introduction to Accounting 2. This is Dr. Mercado, and in today's lecture we are going to be covering content from Chapter 15, which deals with the financial statements and the year-end accounting for a merchandising business. Okay, the problem that I'm going to be covering in this lecture is problem 15.08A, which deals with the income statement, the statement of owner's equity, and the balance sheet. Now, like every other lecture, I do want to remind students to please read the chapter before you attempt any of your assignments. Okay, reading needs to occur first. That way you become familiar with the content and you have a better understanding and can apply it to your problems. Now, this problem that we are going to be covering is comprehensive. It will be on your exam. It is the completion of all three financial statements for a merchandising company. Okay, so here we have the data for the problem. We've got Paul's Pet Store completed the adjusted trial balance below for the year ended December the 31st. Owner's equity as of January the 1st was $504,320. The current portion of the note payable is $2,000. Okay. We are provided with the end of period spreadsheet. All of the information you need is there. And we are required to prepare a multiple step income statement, a statement of owner's equity, and a balance sheet. So I've already got the templates set up, one for the income statement, one for the statement of owner's equity, and one for the balance sheet. Okay. Now, I want to remind students the importance of reading. Your textbook does a wonderful job not only in explaining, but providing you with examples. Okay. Now, in this particular problem, we are going to be preparing a multiple step income statement, okay? And in this type of income statement, is usually used for a merchandising business, which is what we are dealing with in this problem, okay? And the term multiple step is used because the final net income is calculated on a step-by-step basis, okay? So, as you can see from the example, we have the calculation of your revenues, of your cost of goods sold, and then your purchases to be able to calculate all of the data that you need. Okay, we're going to go one by one as we do all of these steps. Now, the textbook does a wonderful job in giving you this illustration because it shows you from what part of the spreadsheet the data is flowing into your income statement. Okay. So the first section deals with sales, okay? And then from sales, we have like item number 2, where we're getting our merchandise inventory. Item number 3, where we're getting our sales returns and allowance. Everything is outlined, okay? So use this as a guide or as a map for when you're preparing your income statement, okay? The statement of owner's equity basically just summarizes all of the changes in the owner's equity during a period. An example is also provided where the data is coming from. Now, if we recall from Introduction to Accounting 1, either your net income or loss calculated on your income statement will flow into your statement of owner's equity. So if you get that number wrong, if you calculate your net income or your net loss incorrectly, then from that point forward, everything else will be wrong because that data feeds into the statement of owner's equity. Here we have the net income for the year that is coming from, that $100,400 is coming from your income statement. Okay. And then last but not least, we've got an example of how to complete a balance sheet. A balance sheet just ensures that your assets equals your liabilities and owner's equity. And it also shows and illustrates where the data is coming from and what section it falls into the balance sheet. Okay, so use these figures as your map or your guide for when you're completing your financial statements. Okay, now let's begin. I'm going to let you all read that on your own because for time constraints, I don't want to bore you with things that you can read on your own. So let's begin with the income statement. Okay, the income statement, we're going to begin with our revenues. Okay, revenues from sales. Okay. So we're going to start off with our sales. Okay, how much do we have in sales? So if we look at the problem, and I'm going to be marking these off as I use them. We have sales of $326,040. Okay, so we're going to go ahead and because we do have to do a calculation, I'm going to put it on the third column, $326,040. So the column depends the level of calculations that we have to do to be able to reach the final total. On the fourth column, you should only have your grand total for your net sales, cost of goods sold, and then the final calculation of your gross profit. If there's any calculations in between, you have to do them in box 1, 2, or 3, or column 1, 2, or 3, depending on how many calculations you need to get to that final point. Okay, so sales 326.40, and then if we look at sales, right below it we have some returns. Okay, so yes, we did make quite a bit of sales, but some of those items were returned. We had $5,360 in returns. Okay, so we have, we're going to deduct less sales, returns, and allowances. Allowances, there we go. Okay, so we have returns of $5,360. So now we can calculate our net sales. Okay, these are the sales after the returns. Okay, so if we get the 326,040 minus the 5,360, that will give me net sales of 320.60. So we did this calculation right here in the third column to be able to calculate our grand total for sales that we're going to put in the fourth column. Remember, in the fourth column we only put our grand totals. Okay. After that, I'm going to calculate my cost of goods sold. Okay, this represents how much did you pay or spend on buying the merchandise, right? So the beginning or the starting point is your beginning merchandise inventory at the beginning of the year. This is January the 1st. Okay, so with how much inventory did you begin at the beginning of the year? Okay, now if we look at the spreadsheet, we have merchandise inventory, but we have merchandise inventory as of December the 31st. Okay, that is not the starting point. So where are we going to get this number from? So if you recall from the closing process, okay, when we close our inventory account, it's a two-step process. First, we have to close out the ending inventory that we have as of that point in time, and then we have to post the new inventory or the updated inventory. Okay, so those closing entries are done to income summary. Okay, so if you look at income summary, line number 24 here, it says that we have a debit of $59,200 and we have a credit of $64,800. So what happens here is we close out our beginning inventory of $59,200, and then we updated it with the new inventory of $64,800. So if you look at the credit for income summary, that credit should match your ending merchandise inventory up here of $64,800. Okay, so the debit on income summary represents the beginning inventory. The credit on income summary represents the ending inventory. Well, we're interested in the beginning inventory, so we're going to go ahead and we're going to use the $59,200. Okay, that represents my beginning inventory. Okay, so we have $59,200 as my beginning inventory, and then we have returns. Okay, on the returns we have the same thing. Okay, we have the reversal and then we have the updated figure. Okay, so for the returns, we're going to have that number right below it, which is the $800 amount. Okay, so those are your estimated returns as of January the 1st. Returns and allowances. Okay, and we have $800. Okay, and then we do the math here. So if we add the $59,200 and the $800, that will give me $60,000. Okay, we're going to get the beginning merchandise inventory plus the estimated returns and allowances that we are anticipating of $800. So we're going to have a cost of goods sold of $60,000. Okay, now we can calculate our purchases. Okay, now we're going to calculate the purchases. Okay, now for purchases, we're going to go down and we have purchases of, this is line number 28 of 162,640. Purchases 162,640. Okay. So we're going to take that over 162,640. So that is, I put it in the wrong cell. Let me see over here, 162,640. Okay, so we've purchased $162,640 of merchandise, and then we have some purchases, returns, and allowances in line number 29. Okay, so we're gonna subtract purchase, returns, and allowances. Okay, and for purchases, returns, and allowances, we have 4,080. Okay. Let me mark that off. Purchases, returns, and allowance. And then we also have purchase discounts. Purchase discounts, we have $3,200 of purchase discounts. Okay. So we're going to go ahead and we're going to mark purchase discounts off. Okay. So now that we've got our deduction in purchases, returns, and allowances, and our deductions in purchase discounts, we can tally those two up. Okay, and then if you add these up, equals that, the 4,080 plus the 3,200, that'll give me 7,280. I can be able to calculate my net purchases. Okay, so for your net purchases, you're going to get your purchases of 162,640 less the total of your purchases, returns, and allowances and your purchase discount. So you're going to subtract that 7,280, and that will leave you net purchases of 155,360. Okay. Now, when you made those purchases, you also had to pay for some freight to transport the goods. Okay. So we have freight of $1,600. So we're going to go ahead and we're going to add the freight. So we're going to add those $1,600, and now we can calculate the cost of goods purchased. Okay, so the cost of goods purchased, we're going to get the 155,360 plus my 1,600. You're going to get your purchases plus your freight, and that's going to give you 156,960. Okay. So now we can figure out my goods available for sale. What do we have available for sale? Okay. So on your goods available for sale, you're going to get your cost of your beginning inventory, what you started off with, plus your purchases. Okay, cost of goods purchased, we're going to add those two numbers, the 60,000 plus your cost of goods purchased of 156,960. That will give you goods available for sale for 216,960. Okay. Now that is what you have available for sale. But if we recall, we have some ending inventory, because if we look at our merchandise inventory, we didn't sell all of it. We still have some sitting there. Okay. So we're going to deduct our ending inventory. Okay, so our merchandise inventory at the end of the year, this is what we have not sold. If we look at our problem, we have ending inventory of 64,800. Okay. Now that number could be picked up from there, or it can be picked up from the income summary, because both of those numbers are the same. You know, we have our ending inventory is 64,800. Now we did estimate to have $1,200 of estimated returns. So at the beginning of the year, we had an estimate of 800. We updated our estimate based on our sales going up. So because we have higher sales, that means we should have a higher amount of our estimated returns. Okay, so we're going to get those $1,200 from the income summary account right here, the 1,200. Okay, so we're going to go ahead and do estimated returns, inventory, December the 31st. Okay, and we have an estimate of $1,200 that is going to be returned. So that will give me a net amount of the 64,800 plus the 1,200. That would give me $66,000. Okay. So now that we've got that number, we can finally calculate our cost of goods sold. Okay. So our cost of goods sold. Okay. Our cost of goods sold is going to be calculated at the very end. To calculate our cost of goods sold, we are going to get the 216,000. Okay, let's just put the formula, 216. That's my goods available for sale, less what I have left over. Okay, and that gives me 150,960. So what you're doing is you're getting your goods available for sale, less the total of your ending merchandise inventory and your estimated return inventory of 66,000. So that will give you your cost of goods sold of 150,960. Okay. Now that you've calculated that, we've already calculated two major components, my sales and my cost of goods sold. So I generated sales of 320,680 and I spend 150,960 on those goods. Okay, that includes freight, that includes any returns, any discounts, all of that good stuff. So at the end of the day, how much did we make? Okay, well, we're going to calculate our gross profit. Okay, this is our gross profit from the operations of the business. Okay, so to calculate our gross profit, you're going to get your sales minus your cost of goods sold. Okay, and that will give you 169,720. Okay, 169,720 is your gross profit. Okay, now from there, we're going to deduct all of our operating related expenses. Okay, because in order for you to run a business, you're going to have operating expenses. Okay, so for the operating expenses, we're going to go down to our bottom section and we're going to bring in all of our expense accounts. Okay, so that is from line number 32. We're going to be working with the information from that point for going down. Okay, so we're going to start off with salaries and wages expense. Okay. And for salaries and wages expense, we have 69,400. Okay. So we're going to just bring in all of our expense accounts. Okay. Next, we have supplies expense. Let me see. I'm sorry, I'm missing one. We have advertising expense. So let's go in order. We have advertising expense. And we have advertising of 1,200. Okay. So let's move that over. So it's just so many numbers. Be very careful when you're picking up the numbers because we can make a mistake very easily. And then we have supplies expense. Supplies expense, we've got $800. Okay. Then we have phone expense. For the phone, we've got $2,736. Then we've got utilities expense. For utilities expense, we've got $2,864. $2,864. Okay. And then we have insurance expense. So we're just bringing in all of our operating expenses. So insurance expense, we've got $1,600. Okay. And then we have depreciation expense building. For the depreciation expense for the building, we've got $10,000. And then we've got depreciation expense equipment, $1,800. Okay. And then we've got miscellaneous expense. So you see, we're just bringing them in. Okay. Miscellaneous expense, we've got $600. Okay. So those are all of my operating expenses. Okay. So I'm going to go ahead and I'm going to tally them up, and I'm going to do total operating expenses. Okay. So I'm going to bring that total in. I'm going to add all of that information. You add all of your operating expenses, and that will give you $91,000. Okay. That is how much you spend in the operating expenses for running the business. Now that we've got that, we can calculate our income from operations. Okay. So to calculate your income from operations, we're going to go ahead and we're going to get our gross profit minus our total operating expenses of $91,000, and that would give you income from operations of $78,720. Okay. That is how much you made after covering your operating expenses. Okay. So your gross profit is before operating expenses, and you bring in all of your operating expenses to calculate your income from operations of $78,720. Now we have some other expenses that we have to account for that are not related to the operations. We've got other expenses. And the other expenses, we've got an interest expense down here of $640. Okay, so that interest expense is not tied to the actual operations of the business. So here we have $640 for that interest expense. Okay, and now we can calculate finally our net income. Okay, so to calculate your net income, you're going to get your income from operations, which is a $78,720, less your interest expense of $640, and that will give you a net income of $78,080. Okay. So a lot of information on this income statement. Okay, make sure that you tackle a section at a time. Okay, as you're working through it, make sure that you refer to the example to figure 15.3. It illustrates how to bring in all of the data from the spreadsheet into the income statement. So I recommend that you review this figure 15.3 carefully. Okay, so that one was a long one. Now we're going to move on to the statement of owner's equity. Okay, for the statement of owner's equity, we're going to begin with our beginning capital. Okay, so we have B. Paulson. Capital, January the 1st. Okay. Now, where are we going to get that information? Well, if you look at the data here provided, it says the owner's equity as of January the 1st is $504,320. So that is given to you right here. Okay, $504,320. So I'm going to carry that over as my starting point. $504,320. Okay. From there, I'm going to add, did we have any additional investments during the year? Well, how are we going to calculate that? Okay, so let's look at the data. Okay, our beginning capital, owner's equity, was $504,320. Okay, now if we look at the information and we look at line number 22, our capital as of the end of the year, we have $534,320. Okay, so let's do some math here. My beginning capital was $504,320, and then my ending capital was 534,320. So I have a difference of 30,000. My capital went up 30,000. Okay, $30,000 because we had 504. Now we have 534. Okay, so we did have an additional investment of $30,000. That is something that you need to calculate using the data. Okay. So now that we've got that, we can calculate our total investment. Okay. We're going to underline that there. We're going to sum that. We're going to sum the beginning balance plus the additional investment. That will give me 534,320. If we look at our capital account, okay, that is what we have, 534 right here. We have 534,320. Okay. Now that we've done that, okay, we're going to go ahead and we're going to bring in our net income or our net loss, depending on what you have, net income for the year. Now that net income is coming from your income statement. So we're going to pick up that number, that 7880. That number is going to flow into your statement of owner's equity. Okay. Now that we brought on the income, we have to figure out, did the owner of the business make any personal withdrawals? Okay, so let's look at our spreadsheet. And right below our capital, we have our drawing account. And yes, the business owner did make some personal withdrawals here of $4,800. Okay, so we're going to deduct those withdrawals of $4,800. So now we can calculate our increase in capital. And the reason it's an increase is because I have net income. Okay. If you were to have, or let's say, if you subtract your income less your withdrawals, if the number is a positive number, then you've got an increase in capital. Okay. If you subtract your income from your withdrawals, let's say you took out more than what you made, or if instead of having income you have a loss, then instead of it being an increase in capital, it would be a decrease in capital. So just remember, if you have a loss, automatically you're going to have a decrease in capital. If your withdrawals are larger than your income, then you're going to have a decrease in capital. Okay. In this case, I generated $78,080 in income, and I took out only $4,800 for personal use. So my capital did increase. Okay. And how much did it increase by? Well, we're going to go ahead and we're going to get the 7880 minus the 4800. So my capital increased by 73,280. So that means that my ending capital as of December, okay, as of December 31st, is we're going to get our beginning capital, or our beginning capital plus our additional investment, which is our total investment in the business. Right now we have a total investment of $534,320 plus my increase in capital from my income less our withdrawals. That'll give me an ending capital of $607,600. Okay, so that is my updated ending capital for Paulson for the year ended December 31st. Okay, so just remember that we are gathering the data from either the data on the top of the first paragraph or from the actual spreadsheet. And like I said, all of the ones that are marked in blue have already been used. Okay, so we are done with the income statement. We are done with the statement of owner's equity. Now we're going to go with the balance sheet. And the balance sheet is very simple. We're just going to bring in, copy the data. Okay, so we're going to start off with our current assets. Remember, current assets are anything that are converted or can be easily converted to cash within a year or be used up. Okay, so if you're going to use them up or they're easily convertible to cash, then they're my current assets. Okay, so we're going to look at the table. Okay, let me hide this for now so I can have quicker access to the data. Okay, I'm going to hide. Okay, there we go. So current assets. Okay, we're going to start in order. The first current asset I have is cash. Okay, because I am going to be doing a calculation. I'm going to put that on my second column, 23,440. Okay. As you are doing it, please mark them off. That way you don't forget that that you have used those numbers. Okay, so we've got cash, accounts receivable. Okay, accounts receivable, you should be collecting within 30 to 60 days. You should not have it longer than that, because if not, it's going to be uncollectible. So your accounts receivable is something that is a current asset, 9,360. So we have our accounts receivable being used up. Okay. Then we're going to have our merchandise inventory. That is also a current asset. You're going to sell it in less than a year. You shouldn't buy too much merchandise inventory that you have it sitting there for a long period of time. That's dangerous, because then it can become obsolete or damaged or whatever the case might be. So your merchandise inventory, 64,800. Okay. So we have 64,800. Okay. And then we have the estimated returns inventory that we are also going to take care of. Estimated returns inventory. And we've got $1,200. Okay. Then we have our supplies. Supplies, we usually use them up in a short period of time, 1 month, 2 months, 3 months. For supplies, we've got 2,400 in supplies. Okay. And remember, the information is already organized. It's your assets, and then we have your liabilities, the payables, okay, and then we have your owner's equity, your capital, and your drawing. Then you have your revenues, and then you have your expenses. Okay, so the data is already organized for you on the spreadsheet. You just have to bring it in. Okay, and then we have supplies, and then we have our prepaid. Prepaids are also short term. Usually we prepay for a year or less. We've got prepaid insurance of 1,800. Okay, and let's mark that one off. Now the next asset we have is land. Is land going to last us more than a year? Yes. Is it easily convertible to cash? Well, sometimes it takes time to sell this piece of land. Okay, so land falls under a completely different section, which is my property, my plant, and my equipment. Okay, this is for your long-term assets. Okay, those fall in a different category. So from that point forward, it goes into a different section. So what I'm going to do here is I'm going to get my total current assets. Okay, these are my total current assets. I'm going to add them up. And I've got $103,000. Okay. Now my next section is property, plant, and equipment. Okay. So the top section is your current assets. Then after that, we follow with your property, plant, and equipment. This is anything that's going to last us longer than a year. We've got land of 90,000. Okay. Now land is not depreciated. The value of land is not depreciated in our books. So you will only have the amount that you actually paid for that piece of land. And here we have a piece of land that we paid for $90,000. Okay, so we've used up the land. We've got a building valued at $350,000. Okay, so we have a building. And I'm going to do a calculation for the building because we have to calculate the net value of the building as of this point in time. So we paid $350,000 for the building, okay? But it's been depreciated, okay? So we have the accumulated depreciation. We're going to subtract the accumulated depreciation for the building. So the accumulated depreciation for the building is $20,000. Okay, $20,000. Okay, so the actual book value for that building Okay, it's going to be the 350 minus the depreciation of 20. So the building is worth, in my books, $330,000. Okay. Next we have store equipment. Okay. I have store equipment that I paid $120,000 for. Okay. So I'm going to mark that off, my store equipment. And it's been depreciated by $3,600. So I'm going to deduct the accumulated depreciation for the store equipment. Okay. And that is $3,600. So the book value of the store equipment is going to be your $120,000 that you paid for it, less the depreciation. That will be $116,400. Okay. So if we add those three numbers together, then that would give me a total of, let's see, equals the $90,000 of your land plus the $330,000 of your building plus the $116,400 of your store equipment. That's going to give you your total property, plant, and equipment of $536,400. Okay. Now we're going to calculate the total assets. Okay, this is a very important line item. Okay, so my total assets will be the sum of your total current assets plus your total property, plant, and equipment, and that will give you $639,400. Okay, so we've categorized our assets based on current assets and property, plant, and equipment. Okay, and the sum of the two, we have the sum of the total current assets and the sum of the property, plant, and equipment. The sum of those two will give you your total assets. Okay. Now from there, we're going to bring in our liabilities. Okay. Liabilities are also going to be broken down between current liabilities and long-term liabilities. Current liabilities are any liabilities that are due within a year or less. You have to cancel those liabilities within a year or less. Okay, so let's look at our liability section, and let me first mark this off, that way I don't forget. Let's mark off the accumulated depreciation for the store equipment. There we go. Now we start off with line number 17. That is your liability section. Okay, so we're gonna start off with let's start off with what they give us on top. Okay, it says the current portion of notes payable is $2,000. Okay, $2,000. So let's look at our note payable. Okay, our note payable, okay, is $16,000. We owe $16,000. Out of those $16,000, $2,000 is due this coming year, within the year or less. Okay, so only the portion that is due this year is going to be falling under the current liabilities. So for current liabilities, we're going to have the portion of the note payable that is due this year, which the problem says it's $2,000. That is given to you in the first paragraph of the assignment. Okay, now that handles my note payable. From there, I'm going to go to my accounts payable. My accounts payable is $9,560. Okay, we're going to bring that in. And accounts payable is an account used for where we're going to be paying anything that we owe short term. So you shouldn't have anything that is taking you longer than a year to pay under your accounts payable. Okay. Then we have our customer refunds payable. Okay. This is money that we owe for refunds, and it will usually be refunded fairly quickly. Okay. In a month or less. So we have customer refunds payable of $1,600. Okay. And then we have salaries and wages payable. Remember, at the end of the year, we don't have we're not going to be cutting checks for people that we owe money for those last 2-3 days of the year. So we put it into a payable. And usually that payable is going to be cleared the following week 2 weeks or month after we close our books, okay? So this is short term, so we have salaries and wages payable. Okay, this is just a temporary account that is used to allocate an accrual of wages that are due to our employees, $1,200. Okay, so we're going to mark that off. And then we have our sales tax payable. Those are also paid depending on the business, within every month, every quarter, it just depends. So we have sales tax payable, okay? And my sales tax payable is $3,440, okay? Okay, so the last item we have is notes payable. Now we said notes payable is usually an agreement where it's going to take us quite a bit of time, a couple of years, to pay off this debt. Okay, notes payable is not a current liability, so we're going to stop there. Remember, current liabilities are anything that you're going to pay within a year or less. So we're going to get our total current liabilities. Okay. We're going to add these up. So we have a total of $17,800. Okay. Now we have long-term liabilities. These are liabilities that are going to take you longer than a year to pay. Okay. And we only have one long-term liability, which is that notes payable. Okay. Now, under the note payable, let me get my calculator. We have a balance of $16,000. But the problem said on the first paragraph, okay, it says right there on the paragraph, okay, that $2,000 is due this year, okay? So we're going to get the balance that we owe less the short term that is going to be due this coming year. So that means that my long-term liability is $14,000, okay? So you're going to get your balance less what is due this year, and that means that you are under the long-term liabilities, you will owe $14,000, okay? So we're going to have the note payable, note payable, $16,000, okay? And then we're going to have less the current portion, and the current portion is $2,000 that we've already put up here. Okay, we've already put it up there, so we're going to deduct it from the bottom. Okay, let me remove that, and then we can calculate our long-term liabilities, which will be your $16,000 minus your $2,000. That'll be $14,000. So now I can calculate my total liabilities. There we go. Total liabilities. Now to calculate my total liabilities, it will be the sum of your total current liabilities plus your total long-term liabilities, and that would give you $31,800. Okay. So the liability section represents the debt, the amount that you owe to the different entities or people or whatever the case might be. This is your obligation to pay $31,800 of money. Okay. Now the last section we have is the owner's equity section. Okay, for the owner's equity section, I am going to go ahead and I'm going to unhide what I hid, okay, because I'm going to need a number from there. Okay, so for my owner's equity section, I'm going to bring in the capital account. Okay, now that number, let me go ahead and remove this. Okay, now for that number is going to come from your statement of owner's equity. Okay, that last number you calculated, the ending capital, that number is going to flow down here. Okay, so whatever you calculated on your statement of owner's equity, bring that number down to the owner's equity section, and that number was $607,600. We don't have to calculate anything. We've already calculated it up here. Okay, so we just bring in that number down to our owner's equity section. Okay. Now we can, let me just center this a little bit. Okay. Now we can calculate the total liabilities and owner's equity. Okay. So my total liabilities is 31,800. My total capital or equity is 607,600. That gives me 639,400. If you can see, okay, the total assets equal the total liabilities and owner's equity. Those two numbers need to match. That proves that the accounting equation is in balance. Okay. If they do not match, then you made a mistake somewhere. You have to go back and retrace your footsteps, review your work, figure out what is it or where is it that you went wrong. Okay. So this will verify that the accounting equation has remained in balance and everything is correct. Okay. So these are the three financial statements, step by step. Please make sure to review your ebook. Great examples are provided. They provide you figures with illustrations that you can follow along for each of the financial statements. Okay, so the data is there. The information is there. You just need to invest a little bit of time to trace your steps and figure out what you're doing. Now you are using this information, this new information for a merchandising company in conjunction with what you should have already learned in Introduction to Accounting 1. Okay, because a lot of the things have already been covered in the first part of the course in Introduction to Accounting 1. Here we're just updating or upgrading based on it being a merchandising business. Okay, so this is the completed problem. Please feel free to review it. Review the video as many times as you need to, step by step for each of them. You can take a picture, review it, and that way you can have a better understanding on how to prepare the financial statements. Okay. Like I said, this problem will be on your exam, so please practice. I highly encourage that you utilize both attempts provided to try to earn the best grade possible, and what's most important, get the practice in there. Okay, and accounting, you're not going to learn it by me talking to you about it day in and day out. The only way you learn accounting is by doing it. Okay, the more you do it, the better you'll get at it. Okay, so that is it for this time. Please make sure to meet all of your assignment deadlines. If you have questions or concerns, please do not hesitate to reach out to me. My scheduled office hours are on your course syllabus. Please schedule an appointment so we can meet and discuss, and hopefully I can resolve your questions. Or shoot me a Blackboard message, an email, or a Pronto message, and I will try to get back with you as soon as possible. Okay? Until next time, have a wonderful rest of your day.